What if the biggest thing keeping you stuck isn't your salary, your boss, or the economy? It's a single monthly payment you signed up for without realizing it would quietly control every major decision of your life for the next 30 years. Most people think the mortgage is just a bill. Pay it every month, don't miss it, and one day it ends. Simple. But here's what nobody tells you at the closing table. The day that payment disappears doesn't just change your bank account. It changes who you are as a decision maker. And once you see that, you can't unsee it. Let's start with some real numbers, because the math here hits harder than most people expect. The average mortgage payment in 2025 sits around $2,300 to $2,800, depending on when you bought. The median household brings home roughly $5,400 a month after taxes. Do that math, and you'll find that most American families are handing over 40 to 43% of their take-home pay to one single obligation before groceries, before gas, before anything. Financial experts agree the safe limit is 28%. Most people are living 15 points above that threshold every single month for 3 decades. Let me show you what that actually looks like with a real family. Meet the Calhouns. Combined income, $110,000 a year. After taxes, retirement contributions, and insurance, they're taking home around $6,800 a month. Sounds workable. Until you watch it disappear in real time. Mortgage on their $380,000 home, $2,400. Property taxes, $380. Insurance and basic maintenance reserve, $520. That's $3,300 gone before they've touched anything else. Remaining, $3,500. 2 cars because nothing in their suburb is walkable. $800 in payments. $240 in insurance. $280 in gas. Student loans, $550. Health insurance premiums, $380. Groceries, $700. Utilities and phones, $420. What's left? About $130. And we haven't touched a single copay, a school activity, an unexpected vet bill, a birthday, or a single dollar of actual savings beyond a basic 401k. The Calhouns aren't reckless. They've never taken an extravagant vacation. They don't have toys in the garage. They did everything right, got the degrees, bought the house, built the careers, and yet, every conversation about changing anything in their lives runs through one silent filter. Can we still cover the mortgage? That question is a background app running constantly, draining battery they don't even know they're losing. Now here's where it gets interesting. When that mortgage disappears, and let's say they make smart moves and kill it at year 22 instead of 30, they don't just get money back. They get options back. But let's be precise about the money first, because people get this wrong. When the mortgage is paid off, property taxes, insurance, and maintenance don't vanish. On a $400,000 home, those ongoing costs still run roughly $800 to $850 a month. So the real freed up cash is closer to $2,000, not the full payment amount. Still, what does $2,000 a month actually do over time? Invested consistently in a basic index fund at historical average returns, 5 years gets you around $146,000, 10 years, $365,000, 20 years, over $1.1 million. You contributed $480,000 of your own money. The market contributed nearly $700,000 on top of that, more than you ever put in yourself. Nobody in that bank office is going to show you that chart. Now I have to address the argument that's forming in your head right now. If your mortgage rate is under 5%, the math says you're better off investing extra money than paying down the loan early. And honestly, that argument holds up on paper. At a 3% rate versus a historical 8% market return, the spreadsheet is pretty clear. But the spreadsheet assumes something dangerous, that you'll actually invest the difference. Most people don't. The moment that forced payment disappears, the cash quietly becomes better groceries, a streaming upgrade, an extra dinner out. Lifestyle creep is real, it's fast, and it's silent. Within 18 months, most households absorb extra cash completely and have nothing invested to show for it. The other thing the spreadsheet skips? The psychological weight of owing money while your investments drop 40% in a market crash. That's not a math problem anymore. That's a 3am problem. And people make catastrophic financial decisions from that place. Research published in the Proceedings of the National Academy of Sciences tracked what happened when people eliminated debt accounts entirely, not reduced them, eliminated them. Clinical anxiety symptoms dropped from 78% of participants down to 53%. People didn't just feel better, they performed better on cognitive assessments. They became measurably less impulsive. And here's the finding that deserves its own moment. The number of accounts closed mattered more than the dollar amount eliminated. Closing a small account produced more psychological relief than getting a large debt partially reduced. Your brain doesn't track balances, it tracks open tabs. The mortgage is the last open tab for most people who've already fought through credit cards and car loans. When it closes, you finally hear the silence you didn't know was missing. Back to the Calhouns at year 22. Their financial independence number, the amount they'd need saved to stop needing to work, just dropped by $600,000. Not because they earned more, because what survival costs them dropped. Mrs. Calhoun takes the role with more meaning and slightly less salary. She can afford to now. Mr. Calhoun finally starts the contracting business he's been sitting on for years. One slow quarter won't cost them the house anymore. Their income didn't change. Their decisions changed because the math changed. So how do you actually accelerate this? On a $450,000 mortgage at 6.5%, switching to bi-weekly payments, cutting your monthly payment in half, and paying every 2 weeks costs you nothing in lifestyle. But it results in 13 full payments per year instead of 12. That single change removes 5 to 6 years from your loan and eliminates over $119,000 in interest. One extra payment per year. $119,000 gone. Adding $500 a month to principal cuts the timeline by about 8 years and kills $150,000 in interest. These aren't dramatic sacrifices. They're the difference between finishing at 55 versus 63 and everything that comes with that gap. When you make that final payment, verify your lender filed the lien release and that your deed is in your hands. Lenders sometimes don't file it automatically. It matters more than almost anything else in this video. Then, rebuild your emergency fund first. 6 to 12 months of your new, lower expenses in liquid savings. Then deploy the former mortgage payment in order max employer. 401k match first. Roth IRA next. Full 401k contribution. HSA if eligible. Then index funds in a taxable brokerage account. At $2,000 a month, 8% average return. You're at $365,000 in a decade, and over $1 million in 20 years. Here's the real thing I want you to walk away with. The mortgage was never just a bill. It was a permission slip one you had to silently check every time you considered doing something different with your life. Want to leave a job that's draining you? Check the mortgage first. Want to take a risk on something you actually care about? Better protect the mortgage first. Want to trade salary for freedom? The mortgage says no. For most people, for most of their working lives, the mortgage is the invisible hand shaping nearly every big decision. Not the only hand, but the one with the tightest grip. When it's gone, the grip releases. And the Sunday night math you've been running in the dark, you won't run it forever. The people who stop earliest aren't always the highest earners. They're the ones who figured out what the finish line was actually worth and ran toward it intentionally. If this reframed how you think about your mortgage, subscribe, because every week, Zen breaks down the financial decisions that shape your life in ways most people never notice. Drop a comment below. What would you do differently if your mortgage disappeared tomorrow?